Welcome and get ready to dive into the thrilling world of investments, where numbers dance, money talks, and the unexpected always keeps us on our toes. Recently, we talked about the Dividend ETF that's many people's favorites. It's the SCHD. Following that video, many of you made a comment that you wanted to know more about another dividend ETF, DGRO. So today, we will be exploring the iShares Core Dividends Growth ETF in detail. We will analyze how the DGRO portfolio is constructed, which sector or industries it focuses on, and most importantly, how it compares to SCHD in performance. People think of SCHD first when they hear the word dividend ETF. But DGRO has some exciting qualities that could make it your secret weapon for long-term success. First, let's take a look at the basics. DGRO was established in 2014, making it a relatively new fund compared to SCHD, which came into existence in 2011. With $23 billion in assets under management, DGRO is certainly impressive, although it's about half the size of SCHD, which boasts a whopping $48 billion. DGRO has an expense ratio of 0.08%, slightly higher than SCHD's 0.06%. There's a reason for this, and we'll get to it soon. As of June 30, 2023, DGRO has a 3-year beta of 0.85, indicating it has less volatility than the overall market. SCHD, in comparison, has a similar beta of 0.89, so the two ETFs are very similar in terms of fees and volatility. Now, let's move on to the exciting part: ETF performance. Be aware that past performance is not an indicator of future results. Since its inception, DGRO has delivered a total return of 157%, including reinvested dividends. And compared to the SCHD, it's almost identical. But the two ETFs have experienced quite different returns in 2023 year to date. While SCHD is down 1.2% as of this video, DGRO has actually increased by more than 4% in this period, outperforming SCHD by more than 5%. We can see that the dispersion gets wider between the two ETFs. If we choose a different time frame, let's say the past 1 year, we see similar patterns. DGRO has consistently outperformed SCHD by 4 to 5% points. That's definitely something to celebrate if you've held DGRO during this period. Both DGRO and SCHD are passive ETFs, meaning they are not actively managed, but they aim to replicate the performance of the underlying index as closely as possible. So the performance difference is likely due to the underlying index each ETF relies on. Before we dive deeper to explore the details though, I would like to ask you that if you enjoyed this video and would like to see more content like this one, please hit that subscribe button below to join our growing community. Now, let's shift our attention to the index that DGRO aims to track, the Morningstar US Dividend Growth Index. According to its fact sheet, the index sets out the following eligibility criteria for holdings. Holdings must exhibit 5 consecutive years of dividend growth, must have a positive consensus earnings forecast and payout ratio of less than 75%, and must not be a real estate investment trust. As long as they meet these criteria, they are included in the index. This means that companies with larger dividend amounts end up taking a bigger portion of the portfolio. While this can make the fund lean toward larger cap stocks, it's somewhat balanced by capping individual positions at around 3% of the portfolio. If we take a look at the fund's holdings breakdown, we can see that apart from Microsoft and Apple, every other constituent occupies less than 3% of the entire portfolio. The weight cap applied to DGRO allows the ETF to include 446 stocks, offering more diversification benefit than SCHD, which only holds 103 stocks. Analyzing the fund's holdings breakdown, we see that healthcare stocks make up the majority of DGRO at around 19%. Financials, technology, and consumer defenses account for 18.4%, 16.4%, and 11.7% respectively. It's important to note that the fund is rebalanced every quarter, so these percentages can change. However, DGRO has a higher turnover rate compared to SCHD, meaning it actively buys or sells stocks more frequently. This could be the reason for its slightly higher expense ratio. What's truly important is that the top 10 assets in DGRO only make up 25% of the portfolio, whereas SCHD's top 10 holdings account for over 40%. This makes sense considering that DGRO has almost 4 times the number of holdings compared to SCHD. The vast diversity of DGRO can be highly beneficial to investors, particularly during market downturns, as it helps smooth out downward volatility. This difference in allocation explains the return difference between DGRO and SCHD we noticed earlier. Now, when it comes to pure dividend yields, SCHD overshadows DGRO. Over the last 10 years, SCHD has consistently given investors a higher dividend yield year over year. Currently, SCHD has a dividend yield of 3.5%, whereas DGRO has a yield of 2.4%. However, dividend yield by itself does not tell the whole story. Let's go back to the fund's eligibility requirements. While DGRO does prioritize stocks with a minimum 5-year track record of growing dividends, it also places a strong emphasis on growth. In other words, DGRO is willing to sacrifice some of its dividend yield for the sake of growth, resulting in a more favorable return over time. In addition, DGRO provides a much broader range of holdings with its 446 stocks compared to SCHD's 103 stocks. This extensive diversification is valuable because it spreads the investment across more companies, therefore reducing the risk associated with any single stock or sector. This diversity can be particularly beneficial during market downturns, as we have discussed earlier. Because DGRO is able to wear out market downturns better, it has a higher Sharpe ratio than SCHD. A higher Sharpe ratio means the fund can produce more return for a given amount of risk level. Now, the real question is, which ETF is more suitable for you? If you prioritize dividends and dividend growth, then SCHD is still the winner. However, if you're seeking solid dividend growth as well as overall price appreciation, then DGRO will take the lead. Currently, DGRO is priced around $50, while SCHD sits above $70. Although stock price alone doesn't determine much, it's worth noting that a lower price tag benefits investors who utilize option selling strategies. A cheaper price requires less capital to sell put options on the underlying stock, which can be advantageous. Overall, DGRO is an outstanding ETF that offers exceptional diversity, impressive growth, and a solidly growing dividend yield. It's a great choice for investors seeking a combination of these factors. However, if you're primarily focused on dividends and dividend growth, SCHD might definitely be more suitable. And that's it for now. Thank you for watching. Please subscribe and comment your thoughts below, and I'll see you all in the next video.